$9 trillion. That's how much the Federal Reserve added to its balance sheet between 2008 and 2022. Not over decades, not gradually. $9 trillion created from nothing and injected directly into financial markets. And if you think that number is just abstract economics that doesn't touch your life, I need you to pay very close attention to what I'm about to show you. Because while most Americans were focused on their jobs, their families, and their daily routines, something fundamental changed about how the stock market actually works. The rules shifted. The game transformed. And almost nobody noticed. This isn't speculation. This isn't theory. This is Federal Reserve data, publicly available balance sheets, documented policy decisions, and market correlations. You can verify yourself with a simple chart overlay. What you're about to learn is a pattern that explains why markets seem to defy gravity for years, why crashes get bought almost immediately, why bad economic news sometimes makes stocks go up, and why the traditional rules your parents understood about investing no longer seem to apply. By the end of this video, you'll understand exactly what the Federal Reserve has been doing, why they've been doing it, and what it means for your savings, your retirement, and your financial future. Because there's a reason billionaire investors have been warning about this for years. There's a reason market behavior has fundamentally changed since 2008. And there's a reason you need to understand this before the next major shift occurs. The next 15 minutes will change how you understand the stock market forever. Welcome to the silent economy. Let me start with something most people don't realize. The Federal Reserve's original mandate, established in 1913, was pretty simple. Maintain stable prices, maximize employment. That's it. 2 goals. Nothing about the stock market, nothing about asset prices, nothing about making sure your 401k goes up every year. But somewhere along the way, something changed. According to the Fed's own data, their balance sheet sat at around $800 billion for decades. That was the baseline, the normal, the way things were supposed to work. Then came 2008. In the span of months, that balance sheet doubled, then tripled. By 2015, it had expanded to $4.5 trillion. And after 2020, it exploded to nearly $9 trillion. What does this mean practically? The Federal Reserve was buying assets, massive amounts of assets, treasury bonds, mortgage-backed securities. And through these purchases, they were injecting liquidity directly into the financial system. Here's what you need to understand. When the Fed buys these assets, they create new money to do it. That money flows into banks, banks lend it out or invest it, and a huge portion of that capital flows directly into financial markets. The result? Asset prices rise, stocks go up, bonds go up, real estate goes up, everything financial inflates simultaneously. This process has a name. It's called quantitative easing, or QE. And once you understand how it works, you'll never look at market movements the same way again. But here's the critical insight most people miss. Markets become dependent on this liquidity. Like a patient on a medication, they need continuous doses to maintain their levels. And when the Fed even hints at reducing the flow, markets react, sometimes violently. This creates a pattern, a predictable, observable pattern of Fed action and market reaction that has repeated over and over since 2008. Let me show you exactly how this pattern has played out. Approximate. Runtime, 4 hours, 10:30. Example. 1. The 2008-2009 response. September 2008. Lehman Brothers collapses. The stock market enters freefall. The S&P 500 drops from over 1,500 to below 700. Retirement accounts across America lose half their value in months. Panic is everywhere. The Federal Reserve, under Ben Bernanke, responds with something unprecedented. QE1, the first round of quantitative easing. The Fed announces it will purchase up to $600 billion in mortgage-backed securities and agency debt. Then they expand it. By March 2009, the program grows to $1.75 trillion. And what happens next? March 2009 marks the exact bottom of the stock market. The S&P 500 begins a rally that would last for years. Correlation with Fed balance sheet expansion? Nearly perfect. The Fed was now in the market in ways it had never been before. But it didn't stop there. QE1 ends in 2010. The market starts to wobble. By August 2010, the Fed announces QE2, another $600 billion in Treasury purchases. The market stabilizes and resumes climbing. This is where the pattern becomes clear. Fed expands balance sheet. Markets rise. Fed pauses. Markets struggle. The relationship was establishing itself in plain sight. Example 2, the 2013 taper tantrum. By 2013, the Fed's balance sheet had grown to over $3 trillion. Fed Chairman Bernanke suggested they might start reducing their asset purchases. Just reducing, not stopping, not selling, simply buying less. The market's reaction was immediate and violent. In the span of weeks, the 10-year Treasury yield spiked from 1.6% to over 3%. The stock market dropped 5.8% in a month. The emerging markets went into freefall. It was called the taper tantrum. Think about what this reveals. Markets had become so dependent on Fed liquidity that merely suggesting a reduction in purchases caused significant disruption. The Fed wasn't even removing money from the system, they were just talking about adding money more slowly. The message was clear. Markets now expected continuous Fed support, and any deviation from that expectation would be punished. What did the Fed do? They delayed the taper, they reassured markets, and the rally continued. Example 3. The 2018 quantitative tightening experiment. By 2018, the Fed decided to try something new, not just stopping asset purchases, but actually reducing the balance sheet, letting bonds mature without reinvesting. Quantitative tightening, QT, Federal Reserve Chair. Jerome Powell called it running on autopilot. The experiment lasted about 1 year. From October to December 2018, the S&P 500 dropped nearly 20%, the fastest December decline since the Great Depression. Credit markets seized up. Volatility exploded. What happened next? January 2019, Jerome Powell reversed course. The Fed signaled a pause in rate hikes. By July, they were cutting rates. By September, they were injecting liquidity again through repo operations. The market responded exactly as the pattern predicted. Stocks reversed and hit new all-time highs by early 2020. The pattern was now undeniable. Fed adds liquidity. Markets rise. Fed removes liquidity. Markets fall. Fed panics and adds more liquidity. Markets rise again. Example 4, the 2020 response. Then came March 2020. COVID-19 triggers the fastest stock market crash in history. The S&P 500 drops 34% in just 23 trading days. Circuit breakers triggered multiple times. Panic everywhere. The Federal Reserve's response was the largest and fastest in history. In a matter of weeks, they announced unlimited QE. Not a set number. Unlimited. They would buy as much as needed. Treasuries, mortgage-backed securities, and for the first time ever, corporate bonds and corporate bond ETFs. The Fed was now directly purchasing corporate debt. They had expanded from government securities into the private market. Their balance sheet exploded from $4 trillion to nearly $9 trillion in 2 years. And the stock market? From the March 2020 bottom, the S&P 500 more than doubled in less than 2 years. The Nasdaq tripled some stocks. Asset prices across the board inflated to historic levels during a global pandemic, during economic lockdowns. During the worst unemployment spike since the Great Depression, stock markets hit all-time highs. If that doesn't make you pause and reconsider what's driving market prices, nothing will. The correlation between Fed balance sheet expansion and stock market levels became so obvious that analysts started creating overlay charts. The two lines moved together almost perfectly. So where are we now? The Federal Reserve began reducing its balance sheet in 2022. Quantitative tightening resumed. And simultaneously, they raised interest rates at the fastest pace in 40 years, from near zero to over 5% in about 18 months. According to Fed data, they've reduced the balance sheet from its peak of nearly $9 trillion to around $7 trillion. That's roughly $2 trillion in liquidity removed from the system. And yet, here's what's interesting. The stock market, after declining in 2022, has been resilient. New highs were reached in 2024, despite higher rates, despite quantitative tightening, despite predictions of recession. What's happening? There are several factors analysts point to. Massive fiscal spending by the government, the AI investment boom, corporate buybacks reaching record levels, and importantly, expectations about what the Fed will do next. Markets are forward-looking. They don't just react to current Fed policy. They price an expected future policy. And what do markets currently expect? Rate cuts. Eventually more easing. The pattern continuing. Here's what prominent investors and analysts have observed. Every time there's genuine market stress, genuine economic concern, the expectation is that the Fed will step in. This expectation itself supports prices. It's been called the Fed put, the implicit belief that the Federal Reserve won't allow markets to truly crash. And this belief isn't irrational. It's based on 15 years of observed behavior. Every significant market decline since 2008 has been met with Fed intervention, every single one. This creates what some economists call moral hazard. If investors believe they'll be rescued from bad outcomes, they take more risk. More risk-taking inflates prices further, which makes any eventual correction more severe, which makes Fed intervention more likely. It becomes self-reinforcing. The question thoughtful investors are now asking isn't whether the Fed influences markets. That's been proven beyond debate. The question is what happens when this dynamic eventually changes, or when the Fed loses its ability to control outcomes. Because the historical record shows that central bank dominance of markets doesn't last forever. Easy money policies eventually create distortions that become unsustainable. Asset bubbles form. Inflation emerges. Currency debasement accelerates. We may be seeing some of these effects already. The inflation spike of 2021-2022 was the highest in 40 years. Asset prices relative to incomes are at historic extremes. Wealth inequality has accelerated dramatically. These are not signs of a healthy, well-functioning market. They're signs of a system under stress. Approximate runtime, 13:15, 14:30. But the Fed is just doing its job. They're stabilizing the economy. Without their intervention, we'd have depressions. And there's truth in that perspective. Central bank intervention during genuine crises has prevented worse outcomes. The 2008 financial crisis could have become another Great Depression. The 2020 pandemic crash could have triggered a complete economic collapse. But here's what that argument misses. There's a difference between emergency intervention during a crisis and permanent market support that never ends. In previous economic cycles, the Fed would intervene during downturns, then step back during recoveries. Normalize policy. Let markets find their own levels. What we've seen since 2008 is different. The intervention became semi-permanent. The balance sheet never returned to pre-crisis levels. Interest rates stayed at zero for most of a decade, and every attempt to normalize policy was abandoned at the first sign of market stress. This isn't crisis management anymore. This is a new operating system, and it has consequences. Savers are punished. Zero interest rates meant zero return on savings for years. This pushed retirees and conservative investors into riskier assets just to earn any return. Asset owners are rewarded. Those who already owned stocks, bonds, and real estate saw their wealth inflate dramatically. Those trying to buy their first home or start investing faced inflated prices. This represents a massive wealth transfer from future to present, from young to old, from savers to borrowers, from workers to asset holders. That's not conspiracy. That's basic economics. Approximate runtime, 14:30, 15:30. So what does this mean for you practically? First, understand what you're actually investing in. When you buy stocks today, you're not just betting on company performance, you're betting on continued central bank support. That's the reality of modern markets. Factor it into your decisions. Second, watch the Fed, not just the companies. FOMC meetings, balance sheet data, Fed chair speeches. These move markets more than almost any individual earnings report. Become a student of monetary policy. Third, consider diversification beyond traditional assets. If traditional stock and bond portfolios are both influenced by the same Fed policies, true diversification might require different thinking. Real assets, international exposure, alternative investments. Fourth, think in terms of scenarios. What happens if Fed policy works as expected? What happens if inflation returns? What happens if they lose control of the bond market? Having plans for multiple scenarios is wiser than betting everything on one outcome. Fifth, stay humble. Nobody truly knows how this ends. Not the Fed, not Wall Street, not YouTube commentators. We're in unprecedented territory. The experiment is still running. The best you can do is understand the system, position thoughtfully, and stay informed. Approximate runtime, 15:30, 16. This is the silent economy. We analyze the patterns that move markets, the forces that shape your financial future, the connections that mainstream media often overlooks. If this information was valuable, if you learned something new, hit that subscribe button and the notification bell. Because the next video breaks down exactly what happens historically when central banks lose control of the monetary systems they created, and the warning signs to watch for. Drop a comment below. Tell me what you think. Do you believe the Fed has fundamentally changed markets? Are you positioned for what might come next? I read every comment. Remember, markets can be confusing. The economy can seem chaotic. But there are always patterns underneath. Always forces at work. Always logic to uncover. Your job is to see what others miss. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.